Good afternoon. I am sure that after this wonderful coffee, all of us are ready for working together. We have a wonderful session because we have three very specific and very different papers. One is risk transmission between green market and commodities. Another writes the relationship between the European trading system and the steel industry. And the last one brings together the municipal market with adaptation investment. The three of them, I think, are very important for the variety of markets that they are related, and second, for the question that I pose for political question. First, the first paper is risk transmission between green market and commodities. Green investment markets are the focal consideration for financial and institutional investors. They are key to tackle the environmental issues. But the problem is that we need assets for diversification. And which are the good assets for diversification? Green asset. The paper analyzes to which extent the commodity markets are able to offer support for the diversification. And the central policy question is, are all commodity assets appropriate for the diversification of a green investment portfolio? The second article is even more close of us. Why? Because the European Union emission trading system gives free allocation to several European industries. In my view, at the very beginning, it was quite natural to give this free market allocation. But now, after so many years, there are many questions. Which firms receive more emission rights? Are firms receiving emission rights the most efficient one? Are European Union firms more efficient than the non-European Union? In my view, the paper analyzes in a very, very good framework a central policy question. Has the European Union failed to provide incentive for decarbonization in the steel industry? And the third one again bring a problem and pose a question. Municipalities that face climate risk are more expensive for financing their own funding. But the ability of financial market to process information has been changed a lot on the last 20 years. And most of them include pricing in a correct way the climate change. And look like that with a very sophisticated way, the author finds that investment on climate change mitigation reduce the cost of financing. And I have a question for them before they start this. Does that mean that they don't have incentive for other for mitigation investment? I will put the question at the end of the table, but now I'll give the floor to our first speaker that is far away, but will be able to explain the problem.
Well, this is great. Thank you very much. It's a pleasure to be at the symposium again, the 10th one. And unfortunately, it was impractical to be there with you. I would have loved to be there and sit in that beautiful hall between those impressive paintings, but I will settle for being between them on the wall. That would be probably just as fine. The paper I'm going to talk about is as you presented very nicely at the beginning. It's about risk transmission between green markets and commodities. So green markets, sort of in a broader sense, and some of and commodities, some of those that are quite common for diversification and portfolio management by investors. This is joint work with colleagues. As you can see, this is sort of cross-border collaboration with Mohammed Abu Bakr Naim. He's at UAE and Russia at the same time, and Sitara Karim at ILMA University in Pakistan, and then it's myself from Copenhagen School of Energy Infrastructure, and my good old colleague Ravindra Nepal from University of Wollongong. This work fits into the picture that especially at the Copenhagen Business School and the Copenhagen School of Energy Infrastructure. We are very preoccupied with the European energy infrastructure and investments in it, and we are constantly working on those topics. But then the issue of financing and funding these investments is the flip side of the story that needs to be brought to the fore even more. So when we talk with the industry, we need to be able to offer also something more in terms of where the financing is going to come from. In terms of the European energy infrastructure, between now and 2050, we are looking at all sorts of estimates from 400 billion to 500 billion to 600 billion euros of investments and so on, and then money will need to come from somewhere. So it's in that spirit that we are exploring different aspects of green markets and for funding these activities. So there will be more work coming from where this comes from, and this is beginning. There is a much scope for good work also in the coming years as we work on these issues. So let me see if I can go to my next slide. Maybe that's how I'm supposed to be doing it. First time I use this system. So the presentation I have, I hope it won't be too long. And it's a simple, almost a simple paper. First, a very brief introduction, and then in terms of contribution to the research, and the very brief literature review. Then I present the methodology and the results, and a few conclusions. A conventional paper. So as I said in my introduction, the green investments are new financial instruments that various researchers and scholars are looking at them, and we hear a lot about them these days. Also, for example, in connection with the the EU's green finance taxonomy. And these markets are growing very fast. As shown here, in 2013, the green investments were about 11 billion, growing to 258 by 2018, and still increasing. By 2020, there were about 350 billion, and the number is even higher as we speak. So there is a lot of focus here, and there is a sort of need for a lot more research in this area to see where in terms of what is green and what kind of investments are needed for mitigation and also for adaptation to climate change and various kind of investments. So this is a growing and important area, and the energy industry has discovered this. I was speaking with the financial manager of a electricity distribution company some weeks ago. They had just tried the green bond market last year, and they had managed to raise a few hundred million euros there, and they were very pleased with the outcome. And I'm sure this is a growing market, and a lot of people are looking at it by investment. But we need to know when marketing them and when promoting these kind of investment vehicles, to tell certain things about the properties of these financial instruments. What else are they good for apart from being green and being part of the green investment portfolio? So the literature is much larger than suggested by this slide. But in 2018, Beato, I mean, they talk about a sizable movement between green bonds and equity bonds. So one of the first interesting contribution, and then followed by in 2019 by the same author and Ugolini, that they show the connectedness between green markets and fixed income markets. Fixed income markets also green bonds belong there, and this is one of the instruments that we need to keep our eyes on. And they have they're very promising for, especially for energy infrastructure research that we are very interested in. The Wang et al. They looked at the green bonds and how they increase fair value. The literature on that is not quite conclusive. We need a lot more evidence, but that's one of the contributions. And then Lei and et al. They show high connectedness among green bonds and fintech and cryptocurrencies. So cryptocurrencies, yes, again, we need to see how that market works and how it connects to, is it a new a commodity or asset emerging, that the connectedness of it to other to green and non-green instruments are we need to understand them. And then last year presented also at this same symposium the paper by Naim et al. I was one of the co-authors as well. We looked at the green bonds in particular, and we showed that they are strongly connected with precious metals, gold and silver. Some of the commodities, common commodities at times of turbulence, where investors find of interest, and then but they're also disconnected with non-renewable energy, and that is also an important feature. In the present paper, we cast the net a little bit wider, and we are not focused only on green bonds, but on the green markets in a wider sense. So we look at the volatility connectedness between green markets and a set of commodities. So it's a set of green markets, as we will see what they are, and a set of usual commodities where investors use to spread their risk and include in their portfolios. We used two different methods in order to get a better sense of, to double check to see if we find the same pattern and the same more or less the same kind of results. We used the volatility connectedness with the dynamic conditional correlations, so the DCC Gorsh model. And then again, we try with the same data set, the time varying parameters or what vector autoregression. So there's two different methods to the same research question and applied with the same data set. Fairly simple methodology and approach. The green markets that I refer to, the previous paper that was presented here last year, as mentioned, it was focused on the S&P green bonds, but This time we widen the scope, and we include some other clean energy and renewable energy indices, such as the Survival Hill and S&P Global Clean Energy and World Renewable Energies are indices, and Global Green Building and Water Utility as among the range that is out there. And in exploring the relationship with commodities, we look at the crude oil and natural gas. They're in blue color. Here they represent the fossil fuel industry, and then the precious metals, gold and silver, and then we look at the copper and wheat. These are some of the commodities that at times of turbulence investors look into, and while trying to sort of hedge themselves against volatility and oil crisis in the financial markets or in the economies. This is just a simple representation of data and how the sample data develops over time from 2011 to 2021. All the 12 markets, the first 6 markets are the renewable and green energy indices, and the last 6 represent the commodity market. So as we see, there is a certain amount of turbulent during this time period. There are certain events that we focus on, and we see how sort of the connectedness between these markets, between the green markets and the commodity markets, evolves or develops. In terms of the empirical results, the first one is the DCC estimates of the total connectedness. So as we can see on the graph, from 2011 to 2021, the focus in terms of crisis or major events are the European debt crisis in 2011 and 12, and then shale oil revolution of 2015, and the Chinese stock market crisis of 2015, and the arrival of COVID-19 in 2020. So as time goes by, we can see that during the time of this the sample, the time varying spillovers change. There is volatility. So the black line in the middle shows the average. So we can see that the volatility or the connectedness between the green markets and the commodity markets, it varies quite substantially, and at least partially in response to the crisis in the marketplace. So this is sort of a bird's eye view of the timeline of the connectedness between these two types of markets. A different way of looking at it is to look at the connectedness in terms of the sending and receiving spillover. We are still in the same methodology of DCC and GORS. So we look at in this slide, we look at the net connectedness in terms of the difference between sending and receiving spillovers between the green markets and commodities. So one picture that sort of emerges from this slide is that the green markets seem to be transmitting spillovers to commodities because they are in the positive part of the graph, and the commodities are in the receiving in terms of the difference between sending and receiving spillovers. And that is sort of interesting observation, and there is a near sort of clear sort of the difference between the behavior of these two markets and their connectedness. And then, but if you put the whole period together and we look at the connectedness of these different markets over the sample period called sort of the full period connectedness, we make a few observations on the right hand side of this graph. We see that there is a fair amount of connectedness between among the green markets on the whole. So these are sort of related. They relate to each other to some extent. One major exception is on top the SPGB, which is the green bond market. They are not. They don't seem to be very connected to the other green energy sort of indices. But on the other hand, they are strongly connected to silver and gold. And this is what we observed and we found in our other paper last year, in terms of when we were just focusing on the green bonds. But if you see, there is a visible this sort of lack of connectedness between the commodity markets and the green markets during this the whole sample period. And then there is also a notable exception at the two red circles, which represent the natural gas and oil. They seem to be rather disconnected from both of these markets. They seem to be a sort of a market of their own, and this is also sort of so the oil and gas markets are not connected to green markets, and they are not so connected to the other commodity markets, such as the precious markets and wheat and copper. So there is a fairly strong picture that emerges, but again, this is about the whole period. If we look away from the short-term sort of fluctuations in these markets. Then moving on to the TVP war estimates, the second method that we use to measure the connectedness. Again, if we look at the sort of time-varying spillovers, the same black line in the middle showing the average of connectedness. Again, the events are the same events: the European debt crisis and shale oil revolution, and the Chinese crisis and COVID. So we see again the sort of a somewhat different pattern of connectedness, but there is something happening in these markets. So the time-varying spillovers. It is useful and important to keep an eye on. Again, moving on with the same method to the net connectedness, as we said, the difference between sending and receiving spillovers between the green markets and the commodities sort of market. We see that the picture is a little bit more mixed in this this method, and at times that we find some overlapping, especially during the crisis periods. There is room for more detailed and careful examination of this, because this is an interesting sort of picture, but we haven't looked at the details of what is happening in this quite in this space. But there is interesting and perhaps somewhat complicated connectedness between these markets. And then when we move on again and we look at the whole period and these groups of markets, we more or less find the same sort of pattern among these. We see that the green markets are fairly connected to each other. The bond market is still up there on the top. By itself, not so connected to the other green markets, and still shows some connectedness to silver and gold as before. But again, sort of the connectednesses are somewhat sort of they may seem a little bit somewhat weaker, but there is still a distinction between the commodities markets and the green markets. And again, the natural gas and oil, they seem to be markets of their own. Some connections to the other ones, but they are distinct, and at least they are not directly connected to the green markets which we more or less can expect when we remember the energy and environmental policies seen at the moment. And so bringing this analysis to the end, the summary is that we find some strong intra and weak intergroup connectedness. that changes over time, of course, and these spillovers are time varying and crisis sensitive. So the even major events, they have an impact on the level and the nature of the connectedness between these markets. That is important to bear in mind. And so at times, at special times, the nature of the relationship and the strength of it is subject to change. And then green markets are transmitted, they transmit spillovers to commodities. That is sort of interesting as well. And then this has implications for the policymakers who want to suggest green markets or green financial instruments to investors, and also for the investors themselves who want to distribute and manage the portfolio risks. But also we hope that there is also important lessons for this, for especially thinking about the hundreds of billions of euro that are needed in the next few decades for investment in energy infrastructure in Europe and around the world. Thank you very much for listening to me, and I end my presentation at this point.
And now I give the floor to María-Eugenia to explain another very different markets.
¿Lo pone ella? ¿La presentación?
Aquí, ¿no?
Let's see. Okay.
Está abajo.
Not working.
Perfecto.
All right. Perfect. So thank you very much. I'm very pleased to be here to present this paper. This paper is a joint work with co-author from the French Agency of Environmental Management, and we are interested in the steel industry and in the interaction between the EU-ETS and the steel industry. The reason for this is the motivation is related to what Professor Costa Campi said today at the opening. Indeed, we have a number of regulations, and the objective is to decarbonize the economy. And the industrial sector is an important part of this. And the EU-ETS is the signature of the European policy in terms of decarbonization. And regarding the manufacturing sector, some sectors that are subject to considered to be subject to international competition are going to continue receiving free allowances, most probably until 2025 and possibly until 2023. And they have been receiving free allowances since the beginning in 2005. So what we are going to do in this paper is actually to consider the steel industry, and I'm going to explain why we focus on the steel industry, to actually consider, first of all, if there is merit for these free allocations to some, in particular to this industrial sector, if there is an issue in the interaction between the EU-ETS and the competitive structure of the manufacturing sector. And then we are going to use a frontier analysis to actually see to which extent the EU-ETS succeeds in promoting the decarbonization of the sector, right? So if we have observed in the beginning of time the decrease in the CO2 intensity and in general inefficiency in this sector. And for those who since I don't like surprises, I hope you don't like surprises either. I'm going to tell you right away which are my main findings. And then I'm going to explain how I do this. So the first finding is indeed that the steel industry is not strongly subject to international competition. And this is a very simple calculation that I'm going to show. So this is a side finding, it's not really a main finding. Then we find that the market is strongly concentrated and that the firm with most market power is the one receiving most of the free allocations. And you can think that this is the case because it's the most efficient. This is what theory would say, but indeed this is not the case. So after performing a frontier analysis, I'm going to also show you that the least efficient firm is the leader, and the most efficient firms are the ones that are the ones that are on the frontier are receiving less of these free allowances and making less over-allocation profits, and that somehow the EU-ETS has failed to promote decarbonization in this sector, since we observe no significant improvement in terms of efficiency through, in particular, between phase 2 and phase 3. So regarding the literature, there are some authors here that have worked on this topic of the EU-ETS. So most of the literature is about fundamentals. There are some other papers that focus on the link with the power sector. Our main contribution is related to these two strands of literature. The first one analyzes the steel industry and has found no evidence of carbon leakage so far, French authors from CIRED. And a second strand of literature that is on the theoretical link between the EU-ETS and a non-competitive downstream market, and say that there could be incentives not to decarbonize. The reasoning is quite simple. If I have a dominant position in the downstream market, I may somehow try to foreclose my competitors through having more permits, or even if those permits are expensive, since somehow if I am attributed free allocations, I have permits that are worth more instead of less, right? So, but this has not been studied empirically. So this is the first paper that analyzes this theoretical strand of this theoretical argument empirically. So why the steel sector? What is important? Well, globally it accounts for 7% of the CO2 equivalent emissions, and it's 7% also of the EU-ETS emissions, I mean the emissions covered by the EU-ETS. And from the manufacturing sector, it is the most important sector, with 27% of emissions that come from the manufacturing sector. It's an essential part of the European economy, since the downstream industries to the steel sector are automobile, building, I mean construction, and so on. And during the period studied, across periods, there are periods where the imports and exports are even thinner, but we can argue that there is really an European market for steel, because imports are lower than imports are lower than 16%, and exports are also lower than 16%. So most of the steel that is used in Europe is produced in Europe, and most of the steel produced in Europe stays in Europe. Okay? So what we do is we build an original data of 28 integrated steel plants, and there you can see that 3 of the firms, I mean, there's one, the market leader, which is ArcelorMittal, is producing most of the steel, and the 3, the other 2, ThyssenKrupp and Tata Steel, are also, I mean, together they are more than 50% of the market. You can also see that in terms of market share. after the alliance, I mean, after the merger between Arcelor and Mittal, that is more or less more than 30% of the market. And together with the second two is around 50%. So it's a very concentrated market. We are also able to estimate the learner index, and you can see that the learner index, unfortunately you cannot see 2018, which is the last, is too big of a chart, but you can believe me that the learner index is more than 3 times, the learner index of the leader is more than 3 times the learner index of the next one, which is also very high as compared to the other firms. And as you can see, the HHI has been, wow, something happened. So the market has been very concentrating. The Herfindahl index is 1,600 and more. Quite stable though, since so it is a very concentrated market. And the way free allocations has been given to this in the steel sector is following that formula, where free allocations are equal to an energy intensity benchmark, which we call BM. Actually, the European Commission has this number, times the historical emissions. So you multiply the historical emissions. Basically, this is what you need to keep in mind, is historical emissions from 2005 till 2008 times a benchmarking reduction factor, right? And so then you have 2 other correction factors. The clef correction factor is 1 for steel, so there's no correction factor, but for other sectors that were supposed no longer to be exposed to international competition, they would have this reduction factor, lower than 1. And the CSCF is a correction factor that comes from the fact that the cap must decrease each year for 21%. But what you need to keep in mind is BM times historical emissions. And that BM for other sectors is calculated on the 10% of the firms that are most efficient. So the idea is, I give you free allocations so that you become like the 10% most efficient of your sector, right? If you do that calculation, is what we call the BM hat. The BM, sorry, that's the next slide. The BM for other sectors would be 0.841, right? So if we applied the rule that is applied for other sectors, not to the steel industry, this rule that I'm going to benchmark the free allocations according to the 10% most efficient, the BM applied to this sector would be 0.8. But this is not what the European Commission chose to do, because they say that due to the lack of data, and I cite the directive, they are going to use a BM related to the inputs used by the steel industry, which are coke and iron ore. And so the BM is double the one that would result from applying a benchmarking of the 10% most efficient. Okay? So by doing this, we analyze the free allocations, and indeed we find that there have been what we call, and the literature calls in general, over-allocation profits. Okay? And so basically you look at the over-allocations and you multiply with the average price for that phase, and you find the over-allocation profits that, as you can see, are very important. So the first firm, which is receiving free allocation, over-allocation profits, that is ArcelorMittal, indeed has twice the over-allocation profits of the second and almost 3 times of the third, right? So there is indeed, and the colors show phase 1 and phase 2. So over-allocation profits have been important, and here you see the percentage of over-allocation profits per firm. Again, you observe that even in the more in the best case scenario, the market leaders are receiving the 2 first most important producers are receiving 50% of the over-allocation profits. So we have most probably an efficiency issue. And we have also calculated which would have been the value of the over-allocation profits if instead of using this way of distributing free permits, we have used the same rule we apply to other sectors, that is the 10% benchmark. And as you can see, the over-allocation profits are inexistent. They're even negative. You could call them under-allocation or negative over-allocation profits. So we wouldn't have this problem if we would have applied the same rule we apply to other sectors. Right? So then what we do is we very simply, we use a frontier analysis to actually try to understand which are the most efficient firms, and unlike other data envelopment analysis, we use one undesirable output, which is emissions. This is the only the novelty, let's say. But otherwise, it's very standard. We use a directional distance function that represents the distance between the observed points and the one that would be efficient. Okay, and differently from what we would expect in theory, we find that the market leader is not the most efficient firm, both in the use of other inputs and in general in terms of the undesirable output emissions. And we also find that the most efficient firms reduce the distance in phase 3 as compared to phase 2 slightly, but ArcelorMittal didn't. So the ones that we really strongly wanted for them to decarbonize didn't actually do it. So this is, it's not very easy to read, but the dotted line is the frontier for the second phase. The continuous line is the frontier for the third phase. In the diamond blue is ArcelorMittal's distance to the second phase frontier, and the dotted blue line is ArcelorMittal's distance to the first phase frontier. So as you can see, first of all, the leaders, which are ThyssenKrupp, Tata Steel, and ArcelorMittal, none of them are on the frontier. So the ones that are on the frontier zone are Vestalpine and ESD. And also the distance between the dot and the frontier in the first, so the dotted line is longer than the full line in both cases. So they became more inefficient instead of more efficient in terms of the use of inputs. Because what I have here is one main input, iron ore, and the second main input, coke. Fortunately, I tried to do a three-dimensional graph, but it was very difficult to read. So in terms of CO2 intensity, I prefer to use a table where you can see indeed that the worst performer is the market leader, ArcelorMittal, across all sectors. So here you have the average, and then you have the ranking per year. And the most efficient are also the ones that were on the frontier in terms of the input usage, which are Vespertine and ISD. So then, as I promised, we also use, we actually measure this change between one phase and the other. So these distances is not simply, we don't simply explore it graphically. We also calculate a very standard Malcolm index to try to see which is whether there has been an increase in efficiency and an increase in technical change that has led firms closer to the frontier in the second phase in the third phase as compared to the second phase. And Vestalpine is the firm who mostly improved, And you will see that except for few firms, most of the firms didn't improve at all, okay? So it's from that I say that the EU-ETS has somehow failed in this sector to promote decarbonization. And this is the case because, as you can see, most of the one that actually improved, the improvement is very low. Remember that the Malcolm index, it's an improvement appears when we are higher than 1, and if we are very close to 1, the improvement is really slim. Okay? So what we actually did to enrich the discussion is we included, so this is the standard Malcolm index. This, what we did is we included the EUEA, the permits, the free permits, as an additional input, and recalculated the Malcolm index, considering those free allowances as something you get, right, for free, as an input, like a subsidy. And we find that indeed the ranking changed. Okay, so the one that had improved the most, indeed now is in the middle, right? And the most efficient in terms, the most efficiency increased when we consider these free allowances as a subsidy has been Tata Steel, which was in the middle before, right? Okay, so. For the sake of time, as I was saying, we have, yes, exactly, thank you. So we have shown that indeed free allowances were, in this sector, were not justified by the risk of international competition, strong international competition. We also showed that the way permits were allocated generated over-allocation profits, and that these over-allocation profits had gone also to the market leaders. And since this is a market, a non-competitive market, this could raise issues regarding to which extent we are at least facilitating these competition problems. Which was the point raised by theoretical literature before, as I said. And the incentives that the EU-ETS has given to improve efficiency, in particular in terms of CO2 emissions, have been, in our results, inexistent. So for next steps, we are thinking about an econometric analysis of this same issue, so an econometric frontier. But we are very interested in discussing with you about other issues that could come up, other ways to prove this very difficult issue empirically. Thank you very much for your attention, and hope you have a lot of questions.
Thank you very much. It has been a very interesting paper and bring many things of the European trading system that we all must study. So thank you very much. And now we have a new different market, the municipal bond market and the adaptation investment, which is quite new, and we are willing to have new ideas.
Thank you very much. While my presentation is being uploaded, let me first thank I would like to thank the organization, the organizing committee for inviting me. It's very special for me because this is the 10th symposium and I was also presenting on the first one. So this is very special, and I remember it correctly. I remember that I had the same chair lady as well. So this is a very special moment for me. What I'm going to talk about is a study that I'm doing with a co-author of mine, Bram van Meijen at the Erasmus University. And we're going to talk about climate change risk and whether it is priced in municipal bonds. And what does it mean? Basically, if climate change risk or the capacity to adapt to climate change risk is priced in municipal bonds, that would imply that municipalities have lower financing costs, pay lower costs to obtain capital in order to do their activities. And there is a whole literature about whether climate change risk is indeed priced in bonds or in other assets like stocks or real estate. But we haven't found so far whether the capacity to adapt to these kind of climate change risks, whether societies are flexible enough, whether that is being recognized by investors, and whether they actually allow basically lower cost of capital basically for these kind of municipalities. So what are we talking about? I mean, I don't want to talk too much about climate risk. We all know what it is. But we are basically in the study focusing on the impact of it. The physical impact, for instance, here, the city of Altenaar in Germany, which flooded 1 or 2 years ago. You see on top the picture before the flood and then after flood a couple of days. We can discuss whether it is completely due to climate change. But this is the type of risk that we're looking at. And more specifically, the risk, potential risks that big cities face. We focus on the study, we focus basically on data from the United States because we have a lot of municipality bonds issued there in the United States. And why are these municipal bonds so interesting? It is because if you would study bonds or stocks basically from companies, well, companies have a way to mitigate climate risk because they can actually move their business to other areas. However, institutions within the municipality, such as schools or other institutions, they actually cannot move to another area. So if we can study the prices of municipal bonds that are used to finance these local institutions, then actually we are, I think, better capable of observing climate effects, basically, in these prices of these bonds. And this study has been done by Painter, published in the Journal of Financial Economics, I think in 2020. And he focused actually only on whether risk of climate change has been priced in these municipal bonds. So he looked at bonds issued, for instance, by the city of Miami, as you see over here. And you see what the threat is that Miami is facing when sea level rises by 6 feet. So the top graph is basically the current situation of Miami, but if sea level would increase by 6 feet, you see that the graph, the photo becomes more blue than it is right now. So the risk of flooding is substantial. And it is substantial to many cities in the United States, but also many cities worldwide. But the strange thing in the results that Painter and others found is that they do not distinguish between the adaptive capacities of these cities. So all these cities are recognized to be facing substantial risk from climate change. The risk is, for instance, measured by elevation of these cities, the distance to the seas. But that means that cities like Barcelona, close to the sea, Amsterdam, close to the sea, Jakarta, Miami, they pretty much all face the same risk from climate change, the way they studied this effect basically in the price of municipal bonds. And to me, that sounded strange, to me and my co-author Bram, because we said, like, if you cannot really compare all these kind of cities, these cities are not the same. And I cannot judge all the cities, but I think one city will be better to adapt to these kind of risks and other cities will. So our question actually was like, is the capacity to adapt to risk from climate change, is that actually being recognized by investors? And do cities or counties that we will study, do they face less financing costs if they indeed are better capable or more flexible to adapt to changes from climate change and risk from climate change? I will skip some slides because of the time. And so what we did actually, we focused on the study by Painter. Painter focused on cities in the United States. Actually, these cities. And these cities were recognized by a study from Hallegatte in 2013 as the cities in the United States most prone to risks from climate change. And Painter looked at whether these cities, the municipal bonds issued by these cities, whether these cities or these counties had to pay more financing costs than basically other cities in the United States, and he found indeed this effect. So we used exactly the same cities that were identified in the literature as being cities in the United States very prone to climate change risk. But then if we wanted to research the question whether the flexibility of the cities, the adaptive capacity matters, we needed to have some data about adaptive capacity. And we were lucky to find that data because we found from, and I have to look a little bit here on the back, that the University of Notre Dame is actually collecting data, and out of the data generating a readiness score, as they call it. It is not data perfectly for climate change risk, so it is more like a general readiness score that, as they see it, reflects how well this, well, let's say this county or the city, it's on the county level, by the way, so to what extent this county is capable to come up with new legislation in a flexible way to adapt to threats, hazards, or climate change risk. It's not by definition climate change risk, so it reflects basically how flexible basically this community is. And to us, we basically assume that this can also reflect how flexible they can adapt their policies to deal with climate change risks. And these readiness scores are based on 3 levels. One is the economic readiness of a city, so expressed maybe by the creditworthiness, taxation, and also subsidies that they have for instance, renewable energy. It is also the governmental, the governance readiness measured, indicated by different measures, and also the social readiness. So how well, how educated people are, how well people respond to change in legislation, for instance, to these climate risk things. So we used that data, and we downloaded data on municipality bonds in the United States. These were about 9,000 bonds for the years of 2015 until 2022. And the basic thing what we wanted to see is whether these readiness scores of these cities relate to how they relate to the financing cost of these municipalities. Here are some examples of these readiness scores. You see, for instance, Los Angeles with a relatively low score of 0.2 on top. You see the city of Seattle with a somewhat higher readiness scores. So these readiness scores have a score between 0 and 1, indicating how ready basically a society is to deal with changes due to, for instance, climate change risk. So what is the result? Well, in a very nutshell, if you make a very simple graph, this is not our final result. What you actually see is that here on the x-axis you see the readiness scores, and on the y-axis you see the issuance costs of these bonds. This is the sum of the yield to maturity, so basically the interest rate, the average interest rate basically that the municipality has to pay on its bonds plus the surge cost that they have to pay. And you see that the line is slightly negative, the relation is slightly negative, indicating that the higher the readiness score is of a municipality, the lower the financing cost is that they have to pay. But this is all based on averages, it just shows the aggregate picture. And here you see the results in somewhat more detail. What we do find here is that in this table, we show, we relate the issuance cost, the combination of the yield to maturity plus the surge cost. Later I will disentangle. And we regressed those costs basically on a number of variables. We used an annual, a dummy variable for the year. And you see in the middle column the third column, you see the part where we include the readiness score. And you see that there is a negative relationship. And that relationship is highly significant, more than 1% or less than 1% p-value. By the way, all the variables that I show here are significant on a 1% level. On the right column, there we include all kinds of control variables, including, for instance, the credit rating. You could, for instance, think that credit rating somehow also reflect this readiness score, but we see actually that even if we do include credit rating and time to maturity and other bond-specific variables, you still see that this relationship holds. So that means that we do find that for those cities at risk, that if they have a higher readiness score, if they are better capable to adapt to changes, that they indeed face lower cost of capital. I'll jump to one other table, basically, which shows our most recent results, actually. What we are thinking of is that climate change risk is not, we do not expect it to show up, let's say, in the next 2 years or so. This is more or less a risk that will materialize itself in maybe 10 years or 20 or 30 years of time. It's longer term. So the question that we had was like, could it be that this effect is stronger for longer maturity bonds than for short time to maturity bonds? So for bonds that will only last for 2 years, or let's say shorter time to maturity, would we see the same effect than for bonds which has a longer time to maturity, as we expect that this climate change risk materializes more in the longer term? That's what we actually found in this table, shown this table. You see below readiness score, what now becomes obsolete in the first two columns with issuance cost and yield. But you see that the other variable comes up, which is an interaction between readiness scores and time to maturity. And what we do assume is that this interaction term is negative, highly negative, and we see that it also is a better fit than in the previous table, which indeed indicates that when the time to maturity increases, so bonds with a longer time to maturity, there you see that this impact from adaptive capacity is stronger in reducing the cost of capital that these municipalities have to pay. What we do see, if we disentangle these issuance costs between yield and spread on the right side, spread reflects the costs that these municipalities have to pay to the underwriters to place the bonds, to sell the bonds, so basically the surge costs. You see that there is some other effect. You see that there also the issuance cost on average has a negative impact. However, there you see that if the time to maturity increases, you see that then the issuance costs also increase. So there you see the opposite. It seems to be that it is more difficult to find investors for bonds with a very long time to maturity than basically for a shorter time to maturity. So you see that the results here for the basically for the spread component, surge cost component is different for the yield to maturity component. Well, this is in a nutshell what we did. So what we conclude basically from this paper is that what we found in the literature so far is that indeed climate change risk is priced, but that result implies that every city has to pay the same, faces the same effect. The more risk you have from climate change risk, the more you have to pay for your financing costs. And in the literature so far, adaptive capacity is not being recognized as such. What we do find here is that adaptive capacity is priced for those cities at risk, meaning that if those cities or those counties can introduce policies which makes them more flexible, gives them more capacity to adapt to climate change risk, that those cities face less financing cost than other cities that are less capable to adapt to climate change risk. And that's our conclusion. Thank you very much.
Thank you very much. I think we have time for a couple of questions.
Well, thank you for these presentations. I'm not sure if the first presenter is still, yes, around. So I had a question for you about the exact mechanisms that explain why there would be a relationship between these green markets and these community markets for the non-financial expert that I am to understand why we would have these transmission mechanisms. And while I have the microphone, I'll ask you questions to everyone. To María-Eugenia, I had a question regarding, because I know that steel can be used, so the better improvement in GHG emissions would come from recycling technologies. And I'm not 100% sure how you account for this. So for instance, if there is not enough scrap from steel to recycle anyway, for example, in Europe, is this, for example, a problem? And therefore, you wouldn't expect necessarily the leader to be the most energy efficient one, because they would produce steel with different processes than, for example, smaller companies that use recycling methods. So that was one thing. And for you, my question would be, do you think your analysis could be downscaled? Because I have the feeling that because you have only 20 or 22 cities, then you're a bit more limited with the statistical analysis that you can produce. So I don't know, maybe if you want to answer now.
Yes, a quick one. This is actually an important question that is it's a simple question, an important one, and it's a bit hard to answer in terms of explaining what are the actual mechanisms involved here. One is that I think a part of the answer is these are still early days. There are a lot of actors in the market that they test this new instrument. And also the green markets are becoming increasingly sort of diverse and they cover a wide range of sort of issues, from production of renewables to fix infrastructure and networks, and so there is quite a bit in the detail that we still need to understand before we can say something about the mechanisms. So the green markets are increasingly becoming more than just one big thing, that markets are indifferent in terms of what they actually do. So they are becoming bigger and they are becoming better known, and each with the different renewables and networks and different parts of the world, depending on the issuers and investors. There's quite a bit that we still need to understand. There is a fair amount of diversity within these markets. We need to be able to unpick some of those before we can say something about the actual mechanisms that are involved here.
Is that fine with the? Yeah. Okay. So regarding your question, so it's a very nice question because it allows me to clarify a little bit. So the key point is that the usage of crude steel and recycled steel, it's different. So indeed, in the paper, we had to show, to be able to calculate this concentration and market power issues, we have to show this indeed. And so the recycled, the steel that can be recycled has other usages, and therefore it's not, we don't consider this, and we concentrate on the crude steel. So this is an important clarification. But there's something that you say that I also think is very interesting, that is that we somehow don't analyze because we are not financial economists. That is the fact that incentives, all this is a price signal that should lead to investments. And as you can see, that there is this, indeed, if you are the market leader, you have a capacity and investment with some costs somehow. And this change is not that easy. And indeed, in this sense, you are right? And indeed, a few days ago, there was on the news, ArcelorMittal was actually on the news saying that they were going to purchase a new plant that is much more efficient. So indeed, this is an issue, and we should account for that. when we think that the EU-ETS is going to make the magic, and there is the timing of investment and so on that is not that easy to account for. But in any case, for sure, there is an issue in terms of these over-allocation profits. So it's reasonable to think that simply by imposing a carbon price, you will not see all investments, especially with very high sunk costs, to align to that price signal. This I agree. But what we argue is that in this case, the effect was exactly the opposite. So we need to better at least what we can for sure say is that we really need to look at the sectors and be careful enough so that the reason why we're favoring them, for example, with free allocations, is well justified, right? Because otherwise, this is not, indeed, is not resulting in the price signal we wish to give.
Also, thank you very much for your question. So your question was about, we only used 22 cities in our sample. So in effect, is it not a too small number, basically, of cities, just to understand this whole effect? We were worried about that as well. First of all, these cities were chosen because we knew by research that these cities were the ones known to be prone to climate change risk. But what we also did, we also downloaded bond data and also the readiness scores for other cities in the United States. But only for 1 year yet, for 2019. We published that, we put it also in the paper. And there we found actually the effect that we found to be non-existent for those cities, especially, or reduced existence, but especially this effect of long-term, which I think is very much related to this climate change risk. We did not observe that basically in the other cities. So this gave us comfort. This effect holds, although your point is still valid that this is only 22 cities. And for further research, yeah, you could think of expanding, data from more cities worldwide. But this is what we could do with the readiness scores that we found. Thank you.
Any question?
Okay. Thank you very much for your 3 very interesting presentations. I have one question for María-Eugenia regarding what you find that the leader is the one that invests less or is the less efficient. Have you considered in your analysis, or up to what point this is explained only by the ETS mechanism or another, subsidies, because it can be that the leader has more subsidies by the municipality, by the regional government, or tax exemptions that do not provide enough efficiency because if they have subsidies, they don't need to improve the processes and the prices are so competitive. Up to what point ETS is responsible at all or not? Thank you.
Sure, yes, we have looked at that because what is interesting in this data is that the installations are all around Europe, and then we aggregate. So we were able to do this. We don't present it here, but we also did this frontier analysis with installations without considering to see whether inside, if some firms had a very installations that were old and therefore very inefficient, and some others that were, and whether there was a geographical also difference because these are across Europe. And in this is not very important. But what you are right, and this is what I show, is that the firms that are inefficient, they are inefficient in the usage of inputs, and not only in terms of CO2 emissions. So because of course the use of polluting inputs has an impact on the emission intensity.
Another question. And it's likely the last one.
Thanks. I'll try to be brief. Thanks a lot to all the presenters also. I found your results extremely interesting, María-Eugenia, and I mean, they were quite counterintuitive, at least in my view. You mentioned that the improvements in CO2 efficiency have been due to technological change rather than the EU-ETS. But I also wonder, I mean, if this autonomous technological change has been induced by the EU-ETS to some extent. I understand that with the very low CO2 prices, this might not have been the case, but maybe with the prices we are experiencing, you know, in the last year or so, you know, this may change in the future. I mean, your study is about short-term effects, which is very nice, but also I'm concerned about the long-term effects. You know, that this very low, this over-allocation, which in turn leads to lower CO2 prices because there is a higher supply of CO2 permits, you know, could have on the technological change, which is, of course, also caused by other things, you know, but high electricity prices, of course, encourage, you know, you to be more technologically efficient. But, well, that was probably more a comment than a question, but yeah, thanks.
Well, indeed, that's why I said next steps. I'm really hoping for your input, because indeed, I think that what you can learn from this paper is more a number of questions than a number of answers, right? In the sense that we are definitely not doing things right, but how should we do them? What is the way, how do we move forward? Because yes, we are going to, as you said, there is the free allocation part, and this is coming to an end soon, not soon enough, because if the proposal of the Commission for the carbon adjustment at the frontier does not pass, this will go on until 2030, from 2025 to 2030 in a decreasing rate, but in any case, it will go on. So how should we do things from now on? And there's the allocation part, and there's also the part related to the carbon price signal indeed. And we didn't observe a major impact in terms of efficiency. So how should we do things moving forward? I think it's a very important question, and I'm open to discuss that and go on in this line.
Thank you very much. We are grateful for you. It has been a wonderful presentation. And now I think that we should go out to have lunch and outside to the garden. And now.